This is the Asia Trade. I'm Shery in Tokyo.
And I'm Paul Allen in Sydney. The top stories this hour. Asian shares set to follow Wall Street higher as bond yields fall. Weaker than estimated economic reports reinforcing the case for Fed rate cuts this year. President Biden struggling to contain pressure to abandon his re-election bid as Donald Trump's lead grows in post-debate polling. Also ahead, a Bloomberg scoop. Gulf giants Aramco and Adnoc said to be considering separate bids for Australian gas producer Santos. Plus, Hitachi says it's ready to spend big on AI and green energy acquisitions. We hear exclusively from CFO Tomomi Kato. Shery.
It was another record close for Wall Street. We're talking about the S&P 500 and the Nasdaq 100 again finishing at record highs. Really, what is it? The 32nd, 33rd? We're really losing count of those fresh all-time highs for U.S. stocks at this point. But really, it was about the expectations centered around the Fed's easing path, especially after we saw weaker than expected results on economic data. For example, we had Treasury yields, in fact, sinking in the New York session after we got the ISM services numbers that showed that activity slowed at the fastest as the slowest pace in more than 4 years. So we are, of course, seeing a little bit of muted moves in the U.S. future session. We will be watching how that progresses throughout the session. But this is the setup across Asia. Of course, we are headed towards the July 4th holidays in the U.S., which is why we also had a shortened session for Wall Street. Take a look at Asian futures right now because the Nikkei and the Topix really at highs that we haven't seen in quite a while. We're talking about the Nikkei being at the highest level since March, the longest stretch of gains when it comes to in more than months. Finally, we get the futures numbers right there, and you can see the Nikkei futures up about 0.1%. As we have the Japanese yen now continuing to weaken against the U.S. dollar, and that, of course, as we continue to watch for any more signals coming from the Japanese economy on where the BOJ goes in its July policy decision, Paul.
Yeah, well, let's get to today's agenda. And, of course, Shery, election risk looming large at the moment. Democratic governors right now in a closed meeting with President Joe Biden. And, of course, Biden's facing a bit of pressure on whether or not to stay in the race. The New York Times reporting that he consulted a close ally about dropping out. The White House swiftly denied that. But we're also getting reports that dozens of Democratic lawmakers are considering signing a letter calling for Biden to withdraw. And then there's the latest New York Times Siena College poll. So we've got Trump with a 6-point lead over Joe Biden now, and almost 3/4 say Biden is too old for the job. So a couple of dates. Election day, of course, November 5, but then on November 20, Joe Biden turns 82, Shery.
Yeah, I mean, we are seeing markets repositioning now for that outcome as well as we head into the presidential elections, especially on what it may mean for the broader economy, especially when it comes to fiscal taps, right? We have already seen the Fed minutes come out from their June meeting. They were a bit more sanguine on how they were able to rein in inflation, but at the same time, officials remained cautious about the risks to the economy, that they wanted to see more evidence in terms of those prices being reined in. Let's turn to our global economics correspondent, Enda Curran, who's joining us now on these Fed minutes. Of course, these were released after the markets closed, so we are yet to see some market reaction. But at the same time, we are headed towards the jobs numbers on Friday as well.
Yeah, interesting set of Fed minutes today, Shery. Two real takeaways. On the one hand, policymakers make the point that they really need to be confident inflation is heading back to where they want it to be, so they're being very careful on that side of things. They don't want to make the mistake of cutting too soon, only to see inflation reignite. But at the same time, there seem to be plenty of cognizance in the minutes that the labour market is starting to soften a bit, and there were some hints in the minutes that perhaps unemployment might start to nudge up a little bit. And there was a broader sort of sense from the minutes that they acknowledge the economy is slowing. So there's it's certainly a dovish side to the minutes that they do want to cut, but they're clearly not ready just yet. And of course, these minutes was from the meeting where they signaled that they're only going to make one cut this year, and that's why the jobs data on Friday, of course, will be all important for where they go next.
Yeah, the minutes and also recent commentary, the Fed reiterating that it wants to see some more data. Well, we're going to see some more data in 24 hours with those US jobs numbers. What is this going to tell us about the Fed's next move?
Well, it looks like the jobs market is softening, Paul. We've had a string of recent of soft indicators in the build-up to it. We had a private payrolls indicator today showing weakness, with only leisure and hospitality adding jobs, mining, resources, manufacturing actually cutting jobs, for example. Most economists think that payrolls on Friday are expected around 190,000 odd, which is very healthy but slowing, and there'll be a lot of devil in the detail. Where are these gains being made? Are they concentrated? What's happening with wage increases? And of course, have there been any revisions to past months as well? So if we get, what broadly speaking, and jobs data reading that indicates the economy continues to soften, and with inflation heading in the right direction, of course it will reignite all bets around the Fed having to move in September. We do have Chairman Powell testifying to Congress next week as well. That would be very important. But as I say, if the jobs numbers come in broadly as expected, suggesting a softening labour market, then you'll see a lot more focus on what the Fed are going to do in September.
Will the presidential elections factor into the Fed's calculation on when they're able to move?
I mean, not overtly. The Fed are at pains to say that they don't take into account politics or the political calendar. In fact, Chairman Powell was at the ECB Century Conference this week, and he made it very clear that they're not in the business of politics, so to speak. But obviously, in the bigger picture of things, the policy is set by whoever becomes president, so they will be very conscious of whoever does win that, and the implications it has for fiscal policy, implications it has for trade, for example, and other hot-button economic topics. I don't think right here and now the Fed are going to move or not move because of the timing of the presidential election, but whoever wins that election certainly will be very significant for where Fed policy goes into next year.
All right, global economics correspondent Andy Curran there. Well, let's bring in our first guest. Kerry Craig is a global market strategist at JPMorgan Asset Management. Kerry, just based on what Enda was saying there, we do get the jobs report on Friday, and we've seen US companies adding workers at a much more moderate pace. We've got a dovish Fed. In terms of easing, does the conversation really boil down to now, as Enda was saying, are we looking at September or December?
Good morning, Paul. Well, for us, I think there's still a strong case they could cut rates in September if the data does play ball, as it were, and you did see further easing in some of the inflation figures that came out, particularly around that PCE number, and if we saw the jobs numbers start to soften off a little bit more. I think the Fed is really trying to keep themselves open to that, but I think more importantly for markets is not whether the Fed cuts in September or December, it's that the fact the next direction in that move is downwards. I mean, they've stopped hiking rates almost a year ago now, and it is a case of thinking about that move being a further easing in policy coming through, really just allowing the Federal Reserve to take its foot off the brake to a certain extent and allow for growth. And the second thing around this is really with the Fed gets trapped into this era of thinking around preemptive rate cuts as inflation is above target but starts to move towards it, or whether it shifts to thinking more reactive if we do see that growth outlook soften more. And that second one would probably be worse for thinking about the outlook for markets if it is a case of seeing a stronger deterioration in the economy and the Fed is really reacting to shore up that growth. For us, we still think they're in the preemptive side of things and they can ease earlier if they want to, and would probably be appreciative of moving ahead of the US election.
Yeah, in terms of the US election, is political risk increasingly becoming a factor that could throw a spanner in the works here, and not just in terms of a second Trump presidency, but also in terms of this conversation about the potential for President Biden withdrawing from the race? Are you gaming out any scenarios around that?
Well, I think it's actually very early to try and position portfolios for thinking around the outcome of the US election. I mean, if you take the polls today, you would say it's going to be a Republican in the White House, perhaps a clean sweep across the Congress, but not sure. And again, that would have bigger implications for thinking about the policy settings. I think the biggest takeaway for us is that, neither candidate or neither party are really talking about efforts to try and reduce the deficit. The latest forecast from the CBO was for a deficit to head towards 9% of GDP should the current current tax cuts be reintroduced or not taken aback from what was penciled in. And so that would be the bigger takeaway, that we could see continued spending in the US economy by the government. That could have some inflationary consequences, and we'd see that movement perhaps higher in bond yields. And that would be the biggest risk for us, that we think about bond yields that should be falling in that weaker growth, falling inflation outlook. But it could be that we see that those yields move up, making positioning and duration a little bit more challenging. So regardless of the policies, I think that fiscal debate is going to become something that's more important for how markets position in terms of where they think about fixed income and bond yields going in the medium term.
Are markets positioning for stickier inflation in other parts of the world as well? It's been really interesting to see the market action in Australia, especially after those retail sales numbers this week.
Yeah, it's looking a little bit less sticky and more stuck when it comes to inflation in Australia, given that we have had some surprises to the upside in those monthly numbers that come through. There's been a little bit more consumption and domestic demand, which is really driving that relative to thinking about that external demand that's coming through. So it does create a bit of a challenge for the Reserve Bank of Australia come to that August meeting. For us, we're still thinking about the idea that, it is going to be a case of looking at that quarterly CPI number that comes out, thinking about what the dynamics in the labour market will be and whether there'll be further softening there to really illustrate whether the RBA does have to hike rates in August. So we're going to say that they're still wanting to hold into next year before they do start their cutting cycle, but the bias is for a rate cut. But they really do have some time to really think about that and some data to digest before that does come through, because they are aware that policy is restrictive in Australia. It hasn't been as restrictive as other places around the world, but clearly there are signs of some softening in the Australian economy, and they'll be more weighted towards that and the impact that it may have consumption. And they also have a bit of a challenge around, mechanically inflation that is going to come down in the coming months, given the subsidies coming through from the government, making a bit of a challenge around hiking rates when inflation will actually start to fall in the numbers that do come through.
Kerry, when you're looking for broader opportunities in global equities, how does Asian markets compare to, say, Europe's, where we are seeing a big discount there?
I mean, at the moment, our approach to equity markets around the world is about finding value. There's been a strong rally in most parts of the markets. Valuations have risen, largely on the fact that we are seeing improved earnings outlook if we take the case of the US. But we are looking for things about finding value in other parts of the world now, where we could see a potential larger rise in terms of those returns relative to, say, the US, when that case of US exceptionalism coming off a bit. Now, this does boil down to a bit of a case around convergence in growth in the world, the US slowing down, Europe picking up, and also convergence across sectors if we think about the balance between services and manufacturing, and that does lean us towards Europe. There is a case of thinking about it moving past the trough in its economy, thinking about that cyclical uplift, some of the structural forces around consumption that could still feed through given those higher savings rates and excess savings that still exist there relative to the rest of the world. And again, that sort of divergence in valuation that is always present when we think about US versus Europe stocks, but even more so at the moment, where pretty much every sector is trading at a discount to that normal discount that would be applied. So a lot more upside potential if you do see the earnings outlook start to improve there and the economy start to improve as well. Near term, the politics are obviously a function of the volatility in the market, but we think that that's probably less meaningful when we think about the medium term returns in a market that's just trading at a discount to its long run.
Kerry, Craig, always great to get your thoughts. Global market strategist at JPMorgan Asset Management. And coming up on the Asia trade, we ask Pepperstone Group whether they think the U.S. market rally can continue. Plus, we get analysis as Vladimir Putin and Xi Jinping meet for a second time in less than 2 months. Also ahead, our exclusive interview with Ukrainian President Volodymyr Zelenskiy as he calls on China to help end the war with Russia. This is Bloomberg.
российско-китайские отношения.
Russian-Chinese relations of comprehensive partnership and strategic interaction are experiencing the best period in their history. They are built on the principles of equality, mutual benefit, and respect for each other's sovereignty. Our cooperation is not directed against anyone. We do not create any blocs or alliances. We simply act in the interests of our peoples.
It is Russian President Vladimir Putin as he meets with Xi Jinping on the sidelines of the Shanghai Cooperation Organization Summit in Kazakhstan. Well, let's bring in our Greater China Senior Executive Editor, John Liu. John, it's not that long ago since Putin and Xi had their last meeting. What's on the agenda this time?
I think it's just a continued affirmation, especially for a global audience, to see that Putin and Xi are on the same page, that the relationship is strong, that there is no wedge being built between the two countries. Russia, obviously more dependent on China economically for supplies of goods, including allegations from some American allies that China is supplying or planning to supply attack drones. And so the dependence there is more pronounced than ever. And Vladimir Putin and Xi Jinping both wanting to portray a close relationship, a personal relationship on a global stage.
We weren't expecting either Ukraine or any Western backers to be attending this meeting, but how long will the conversations be, at least on the sidelines, when it comes to the war in Ukraine?
I mean, there has been talk about finding a political solution to the war in Ukraine. Xi Jinping talked about it when he spoke to Vladimir Putin. I believe when Vladimir Putin met with President Erdogan of Turkey, there was talk about that as well. Everybody, at least publicly, has said they want to help to find a way to end the conflict. The problem is, how do you do that? What are the details? What does Russia get and what does Russia give up to be able to find that peace? I think that is going to be the devil in the details.
John, we're also expecting perhaps Belarus to be added to the SCO. Iran joined last year. Are there more members considering joining? And is this grouping becoming more significant?
Well, Turkey has expressed an interest in joining. The number of countries in this group has steadily grown. And I think as that happens, there is more influence attached to the SCO. It is sort of an alternative infrastructure for diplomacy and international relations that excludes the West and excludes the United States. It's offering an alternative for countries like Russia, like China, who are trying to build economic, military, and diplomatic ties beyond the reach of Washington.
Our Greater China Senior Executive Editor John Liu there with the latest on the Shanghai Cooperation Organization. We also have another group meeting very soon, NATO leaders meeting in Washington, and before that, Ukrainian President Volodymyr Zelenskiy now speaking exclusively to Bloomberg. He told us Beijing can play a key role in ending the war.
I would like China to play a serious role. It's a big country, and really it's the second largest economy, and Russia really depends on it because they don't have another place to export many of their goods because of the sanctions.
You can catch the full interview with the Ukrainian president later in the hour. That's coming up at 7:30 a.m. Hong Kong. We have more ahead on the Asia Trade. This is Bloomberg.
A Senate committee report on Australia's corporate watchdog is recommending the agency be split in two to boost its enforcement capabilities. The Senate panel is also recommending the whistleblowers be given incentives. Deals and banking reporter Harry Brumpton joins us now for more. So, Harry, what was the reason for this review?
Well, the corporate cop's been kind of dogged for quite some time, Paul, with these allegations that it has been quite ineffective, or just like at least not meeting its mark because of unwieldy bureaucracy. It comes from complaints from both whistleblowers who've said they weren't adequately protected or listened to, as well as even the former chair of the organisation, James Shipton, came out. It was last year or the year before, talking quite openly about his views for the need for reform from it, and some of the internal politics that really put him in a dark place personally, and he felt quite attacked and unprotected by the organisation as they launched campaigns. So this report, it was a committee that heard from all sorts of people over nearly 2 years actually, and there was heard that the organisation was quite bureaucratic, motivation was poor, and some of the numbers about cases that they've been bringing to the Commonwealth Department of Prosecutions has really dropped off the last few years as well. So out of that's grown a few recommendations. There was 11 in total. The biggest one, as you said, was splitting this up because they've got a lot of ground to cover. I think is part of the problem, and then also new protections for whistleblowers, some remuneration in the kind of US style of payouts for people that have been vindicated for bringing stuff to public attention, as well as more reviews basically going forward, I think, as well. So that's the kind of core of it.
All right, I was going to wait for Shery to ask you a question there, but is this going to be implemented? I mean, it's going to go to the Treasurer, Jim Chalmers, now.
That's right, and the big issue is, how much support does this review get? It was run by a New South Wales senator who's from the Liberal Party, so whether that is something that Labor will put down a dissenting view from. There's been a bit of brinksmanship and politics around this, and the Treasurer has made some noises that he views this as somewhat of a political campaign, although there is obviously merit to some of the complaints as well. So whether or not it gets kind of picked up, or if not, just kind of put in the drawer until such time as perhaps a Liberal government takes power. We're running a 3-year election cycle here in Australia, so it might be as soon as next September. So the calls may have some meat down the track. It's just depends on the politics of the situation and who gets around it.
And how about ASIC? Have they had anything to say about this, or should they even have anything to say about this?
They've, defending themselves, and look, they have a proud track record in some ways. They are, they do get reviewed. The review schedule has dropped from every 2 years to every 5 years, but they do get reviewed by a committee about their effectiveness, and they're actually going through that right now. That's the Financial Regulatory Assessment Authority, I think they're well aware of the pressures on the organisations and have been quite public about defending themselves about some of the big cases they've brought and some of the matters that they've managed to bring to public attention.
All right, our deals and banking reporter Harry Brumpton there on the potential split up and review of the regulator ASIC here in Australia. Now, the latest on the corporate front, Bloomberg has learned that Saudi Aramco and Abu Dhabi's Adnoc have been separately studying potential bids for Australian gas producer Santos. Now, that's as the Middle Eastern energy giants seek to ramp up their foreign gas investments. Santos has LNG projects in Australia, Papua New Guinea and Timor-Leste. Sources say Santos could also attract interest from other potential buyers, and deliberations are ongoing. Bloomberg has learned that the EU is working on a proposal for import duties on cheap goods bought from online platforms outside the bloc. Sources say the move would primarily target Chinese retailers such as Shein, Temu and AliExpress. The EU currently has a $161 duty-free threshold for online purchases. That's meant for small gifts or personal packages. We have more ahead on the Asia trade. Stay with us. This is Bloomberg.
This is the Asia Trade, about 30 minutes away from the major market opens. Here are the top stories that you should know. Asian shares set to follow Wall Street higher as bond yields fall. Weaker than expected economic reports reinforcing the case for Fed rate cuts this year. Meanwhile, the central bank's June minutes show officials awaiting additional evidence that inflation is cooling and divided on how long to keep rates elevated. Dozens of Democratic lawmakers are considering signing a letter demanding that President Biden withdraw his re-election bid. A senior party official says Democrats running in traditionally safe districts are circulating the letter. Meanwhile, Donald Trump's lead over Biden has widened to 6 points in two major national polls. Russian President Vladimir Putin has met with China's Xi Jinping for the second time in 2 months. Putin told the Shanghai Cooperation Organization summit in Kazakhstan the ties between the two nations are at their best in history. Xi, meanwhile, defended China's role in Ukraine and vowed to deepen coordination with Russia.
The Ukrainian President Volodymyr Zelenskiy says if Donald Trump has a plan to end the war, he'd like to know about it now. The Ukrainian leader spoke exclusively with Bloomberg about the U.S. election race and challenges around agreeing to ceasefires with Russia.
We've had agreements about ceasefire between Ukraine and Russia, and Russia has been always breaking all the agreements and has been killing our people. So only if it's on some international forum in the presence of the countries, leaders who are trusted. They might have different ideas, different views on the stages, how this war will be over, but we all have to be on the same side. We have to trust each other. Trust is very important. The Peace Summit, by the way, has shown that we can follow this plan. Over 100 countries were there, and today we're talking about their nuclear security and energy security, and there will be a clear plan. So the ceasefire also needs a clear plan. We must understand that Russia would not be using ceasefire to simply accumulate equipment on the territory, our territory that they've occupied, because we will not be striking them. I mean, they can use that to create a strong fist here and then accuse us of breaking the ceasefire and start another invasion. So it's really complicated for us. It would take a significant loss for us if they invade again, as in the beginning of 2022, when they have almost reached the capital city, and they accumulated a lot of equipment on the territory of Belarus. And Belarus kept saying that, no, it's just the exercise. No occupation is in mind. It's just the training. It's just military games. It's very important. I really don't want to have this big trouble for my country, because we are at war already. Giving the advantage to Russia now, it's just impossible. We need to be smart. And it's important also who will be responsible for this, besides the Ukrainians who are paying with their lives. Which country will be responsible? It's easy to just talk about ceasefire, but it's very difficult to enforce it, to keep it. It's very difficult to find those who will respond why the ceasefire
But we're going to see
broken.
more calls for a ceasefire, especially as the world politically is moving to the right and potentially moving to the right in the United States. You have said this war is dependent on U.S. aid. I want to ask you, did you watch the presidential debate between Joe Biden and former President Donald Trump?
So, first and foremost, the ceasefire is an important element in any plan to finish the war. So, a ceasefire is not finishing the war. We've been there. It would be just a frozen conflict. And it would be frozen for the aggressor, because it would be frozen on our territory, and our people would be under the occupation. This gives a clear advantage to one side. That's why it's easy to offer different proposals of ceasefires. But what's important? It's important to find answer what would come after. It's the matter of not just the victory. There are many people talking about ceasefire, and it's fine that people are talking, but what would happen next? That is the question. For example, what's the next step? What's the third step? What would be the step when Putin breaks the ceasefire? After the ceasefire, a month after the ceasefire, will he pull out the troops out of Ukraine? Who guarantees that he will pull the troops out of the occupied territories? And there's silence. nobody has answer. I'm not accusing. I just want to explain that we are at war and we understand this. So, the debates.
Well,
Yes, I saw
because
debates.
the answer of how this might all unravel will depend on also who's at the table from the United States.
І, зокрема, буде залежати.
Amongst other things, it might depend on who is the president of the US. Yes, that's a fact. Because the US, the United States of America, today are probably the most powerful player. So the matter whether the United States would be the major international player, whether they want that, or they want to focus more on their internal politics. I cannot say. It doesn't depend on me.
So did you watch the debate?
Yes, I watched the debates. So first and foremost, I want to say, I don't know, maybe it would be out of tune to what we see in the US media, but I watched. And we are not electing the president of the US, so I didn't look at the incumbent president and the former president. I looked at them in terms of Ukraine.
President Trump said he'll end the war before he's elected.
Yeah, I heard
What do you
it.
make of that?
І я скажу чесно.
Let me be frank.
Давайте, наприклад, це вирішує.
For example, well, the decision is on US public. But let me just have some reasoning. Так, але для вас це важливо.
Ну, давайте уявимо,
Yes. So let us imagine that the winner might be Trump in November.
як закінчити війну.
And he knows how to end the war. He has a plan.
Я, як президент війни,
Me, as the president of a country at war, not a theoretical person, but a real-life person, I would like to be prepared.
мільйонів, ми дуже велика.
We are 40 millions. We're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish war fast? Tomorrow, do we want the war to be over tomorrow? The war didn't to start. It was Putin who started it. But I hope you agree that it would be fair. If Trump knows how to end this war, he should tell us today. Because
Якщо там є
if
ризики,
there are risks to Ukraine's independence,
ризики, що
if there are risks that we will lose the statehood,
підготуватися.
we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US or we'll be all alone.
Ukrainian President Volodymyr Zelenskiy speaking exclusively with Anne-Marie Horderin in Kiev. Take a look at how futures are setting up after we saw another record high for the Wall Street session. We're talking about the S&P 500, the Nasdaq, all gaining to fresh record highs. We, of course, had weaker than expected economic reports, including services activity contracting the most in 4 years. So the expectations for a Fed rate cut being heightened, and you can see that perhaps translating into the Asian session, with Sydney futures higher by 0.9%. Of course, we're watching the Aussie dollar very closely because retail sales rose by more than expected, so you have more expectations of a rate hike coming from Australia. This is Bloomberg.
Hedge funds are losing favour among managers of Australia's $2.6 trillion pension pot. Bloomberg's superannuation and pension funds correspondent Amy Bainbridge joins us now from Melbourne. So Amy, tell us what's going on with this shift. What's behind it?
Paul, this is probably a story of the enormous scrutiny that Australia's $3.9 trillion pension industry is under. Several years ago, the government here introduced a performance test. So each year, the funds are assessed on not only their returns, but also the fees that they're charging to members. And what that means is that the investment fees the pension funds are paying are under enormous scrutiny as well. So we have some figures from a research house called Chant West, which shows that the drop-off since that test was introduced in the growth investment option, so there, I guess the higher growth, riskier investment mix, have gone down from around the 2% mark, the allocation to hedge funds, to around 0.6 of a percentage point. So there really has been a drop-off, and on top of that, we've spoken to around half a dozen of the larger and mid-sized pension funds that have all said that they're substantially reducing or have completely reduced their allocations to hedge funds to zero.
So that drop-off notwithstanding, there is still business for hedge funds in Australia. What are people telling you?
I've spoken to one of the hedge funds here in Australia, Tribeca, who said that they haven't seen any drop-off in demand from superannuation funds, as we call them here, Australia's pension funds. We also know that the sovereign wealth fund for this country, that's the Future Fund, has more than $200 billion under management. That fund is also still using hedge funds, has around 10 to 20% allocation to hedge funds.
So what about the popularity side of things with pensions instead of hedge funds?
Well, that's right, Paul. We know that the hedge funds here have increasing exposure overseas and also to private markets. So looking away from equities exposures now, they have about 1/5 of assets in total allocated to private markets. That includes everything from property, including infrastructure, residential housing, student housing and the like. They're also big believers in private credit and private equity. So we know that the pension funds here have a growing appetite for private markets exposures, and one fund had told me that instead of allocating to hedge funds, they are indeed allocating more money to infrastructure projects and assets that might suit the higher for longer rate environment.
All right, Bloomberg superannuation and pension funds correspondent Amy Bainbridge in Melbourne. Shery.
And Paul, we continue to watch the ongoing rally in Japanese equity markets, and investors really turning more bullish when it comes to Japanese stocks. Again, speculation also growing, of course, that the Fed may soon cut interest rates. That's having another really impact when it comes to a little bit of a boosting trend for Japanese markets. Asia equities reporter Winnie Su joins us now for a preview ahead of the market opens. And Winnie, I mean, we continue to talk about this incredible rally with the Topix now at another record high, or very close, what, 0.4 percentage points? Yes. So what is the feeling right now out there that this rally may last?
Yeah, so we're likely to see Topix and the Nikkei hit record high very soon. So we saw like the U.S. hitting another record high just yesterday, right? That's going to provide some positive boost for the Japanese markets as well. And people are really excited about this because the Topix hitting record high potentially means that the rally is actually broadening. So it's not just because Nikkei hitting record on, stronger U.S. tech stocks, but it's because the Japanese market overall is getting better, and it indicates more interest in the overall market sentiment. So that would be something that gives investors more confidence coming back to the market.
Yeah, because when we talk about U.S. markets, we talk about the concentration risk of the Magnificent Seven, right? When it comes to Japanese markets, I mean, who could have imagined the Nikkei past that 40,000 level, right? But at the same time, there are some concerns that if the yen depreciates too fast, that might actually hit sentiment. What are people saying?
Right. So now that we're heading into the second half of the year, we're looking at how the stocks are looking towards year end. And that's one of the big concerns that people is flagging, because the excessive weakness in the yen can potentially mean the domestic demand is not going to be as strong. And it can potentially mean that authorities is going to step in for intervention, which is going to cause some volatility in the currency. And also when it comes to dollar-based investors, the yen at this level is going to hurt their dollar-based returns. So that's something that they're closely watching. And another point when it comes to concern is around how, Japanese stocks might not look as attractive as some of the other alternatives in Asia. So you've got China having quite low valuation, and the third plenum is just right around the corner. So there might be some positive boost in terms of policy. And in terms of India, post-election, people are quite positive to see what other policy might come out of the current government.
Could there be some positivity also because Japan is sort of portrayed as this beacon of stability at a time when we're seeing so much political risk as well? Will there be any impact from the U.S. presidential elections at all?
So that's a really interesting one because we've been talking to strategists and they're saying that Japanese stocks might actually be the best bet when it comes to Asian market in terms of how the U.S. election can, or how the higher possibility of Trump's victory can impact Asian markets. They're citing a higher U.S. dollar may lead to a weaker yen, which is going to be good for stocks. And also Trump's tariff on China, that's going to help the supply chain in Japan. So that's going to boost the demand for these exporters as well. And the heightening U.S.-China tension, or U.S.-China-Taiwan tension, that's also going to kind of encourage investors to look outside of these markets and potentially benefiting Japanese stocks.
Winnie Su, our Asia equities reporter, with this incredible rally that we've seen in Japanese equities. One stock that's really gained ground over the past year is Hitachi, up more than 80% year to date. Well, the company now is saying that it's ready to spend hundreds of millions of dollars on acquisitions. Chief Financial Officer Tomomi Kato told us exclusively that the focus of the deals will be on artificial intelligence and green energy.
We have three major sectors at Hitachi, including our business sector, in which we develop software. We are developing software for our customers, and of course we do the programming and coding. But we've learned through various demonstrations last year and this year that on average we can improve the efficiency by 30% or so, and we're now trying to incorporate this into our projects. This will help reduce the time and people needed for project development. If we had more human resources, we would be able to meet customers' needs better. But if the productivity of coding is increased by the use of AI, we can take more orders and help customers looking to digitalize operations.
Which is why you're training 50,000 employees for generative AI as one of your business strategies. When do you expect all of this to start paying off in terms of, as CFO, when will it start affecting the bottom line?
I believe that we will see the effects of the return on investment starting this fiscal year. However, since it hasn't been long since the program began, the effect will be minor, and the bigger impact will come from the new medium-term management plan that will start next fiscal year.
How are you expecting those partnerships that you have with the global AI players like Microsoft and Google to factor into those calculations? We are
in the digital business, so we have customers who want to use AI but don't know how to use it, or what's the most efficient way to use it, or they want to use it but they don't want to release their confidential data to the public cloud, for example. How do we guarantee security, and how should we use the public cloud and on-premises servers, which we call a hybrid cloud? In this case, we need technology for data management. To achieve this, we of course have the technology, but for example, we do not make our own large language models, but use LLMs made by other companies and train them to become suitable for our customers and for us. In that sense, the alliances we have with Microsoft and of course NVIDIA, whose servers are crucial, are not only beneficial to us, but are also very effective in providing various solutions to our customers. I think this will help distinguish us from the competition.
The fact that we're seeing such growth in artificial intelligence and the infrastructure that might support the future, Hitachi having businesses across all parts of the economy, including, of course, the power industry, are you factoring in that as CFO when you're looking at your numbers?
The effect of generative AI is extremely high in enhancing our productivity and the solutions we provide to our customers. As you mentioned, for example, the use of generative AI naturally requires data centers, and the demand for these data centers is increasing. Data centers require electricity, which in turn requires transformers and other power equipment. We have a business model called Power Grid in the green energy and mobility sector, where we also manufacture transformers, and orders for these transformers are also increasing. In this sense, we believe there will be a ripple effect from AI to data centers to the power grid.
Hitachi Chief Financial Officer Tomomi Kato speaking exclusively to Bloomberg. And if you miss any part of that conversation, TV Go is your function. Also, you can watch us live and see our past interviews. You can dive into any of the securities or Bloomberg functions that we talk about and become part of the conversation by sending us instant messages during our shows. This is for Bloomberg subscribers only. Check it out at TV Go. This is Bloomberg.
About people. It's about their lives.
All right, you're seeing there the Minnesota Governor Tim Walz speaking at the moment. A number of high-profile Democratic governors, Shery, have just had a meeting, a closed-door meeting with President Biden about his future in the race. Walz there saying that President Biden is fit for office. We also heard from Wes Moore, who says he'll stand with Biden as well. Shery.
Yeah, we continue to watch what's happening around the White House, of course, as we continue to see this anxiety over President Biden's ability to beat Donald Trump in the presidential elections in just 4 months from now. Of course, we have seen really news and reports that Democratic officials, donors and voters are losing confidence in the president's ability to beat Donald Trump come November, Paul, and congressional Democrats sort of distancing themselves as well from the president, because we have to remember that if they are able to control at least one chamber of commerce, that would give Democrats the ability to negotiate with a potential Trump White House. So we have heard from sources, a senior Democratic Party official, saying that dozens of lawmakers are now considering signing a letter demanding President Joe Biden withdraw from the race. And we will continue to watch those developments as we had Democratic governors now leaving the White House, Paul, after meeting with the president.
And at the same time, we have data as well showing that bets on Kamala Harris becoming the new candidate for the Democrats are surging. So there you see implied probability of Kamala Harris' nomination is surging even off the back of that meeting with Democratic governors. Market opens in Sydney, Seoul and Tokyo next.
This is the Asia trade. We're counting down to Asia's major market opens. After another record high on Wall Street, we had weaker than expected economic data, leading to more speculation about a Fed rate cut coming sooner than later. We, of course, had a shortened session ahead of the July 4th holiday, but we saw Treasury yields sinking after the latest ISM services numbers, activity contracting the most in 4 years. Not to mention that we also had labor data slowing down, continuing jobless claims at the highest since November 2021. This ahead of the June non-farm payrolls report coming out on Friday, as we also got the FOMC minutes for the month of June that analysts said potentially leaned a little bit dovish. Officials said they were waiting for additional evidence that inflation is cooling down, but they were very much focused on downside risks as well. This is the open across Asia right now. The Nikkei up 0.4%. We're talking about near record highs and above that 40,000 level. Same for the Topix, which is also around record highs. It's already at the highest since 1989, a gain of more than 20% for Japanese stocks as we continue to see a weak Japanese yen holding steady at that 161 level. Of course, we've been watching Japanese government yields very closely because the 10-year yield has been on an upward trajectory, rising towards that 1.1% because of the weakness of the Japanese currency and speculations that the BOJ will need to move. We're seeing a little bit more downside on yields on today's session. But of course, we're watching how Korea is also coming online because we saw the government raising South Korea's growth forecast to 2.6% from 2.2% for this year. We have seen this incredible boom when it comes to semiconductor demand because of artificial intelligence. You have the Kospi gaining 0.8%. The Korean won, though, still pretty weak. It's been weakening against the US dollar. throughout the week. Take a look at how Australia is coming online, because it's a different story for the Aussie dollar, which has outperformed major currency peers, especially after the retail sales numbers that we saw in the previous session rising by more than expected. So now you have analysts and economists expecting the odds of an interest rate hike to continue rising this year. RBA OIS pricing showing the probability of a November hike at 68%. It was around 65% before those retail sales numbers came through. But it was really about monetary policy and how that's impacting the markets. Let's bring in our next guest, who says a Fed put is firmly in the markets. With us now from Melbourne is Chris Weston, head of research at Pepperstone Group. Chris, always great to have you with us. Digest the FOMC minutes for us and what the implications are for the markets.
Well, I didn't take too much from them. And obviously, the bears will take, the hawks will take something out, the doves will take something out of the minutes. But I think on balance, people are saying they're probably sort of more tilted towards the dovish camp. And I think since the actual Fed meeting, there have been so many Fed speakers that a lot of it was pretty much well known to the market, and we haven't learned a lot. I think if we go back to the prior session, though, when we heard Jay Powell speaking at Sintra, I think that was probably a little bit more enlightening for me. He did say that the labour market was finally was in a better balance, but he did say that there was very, very little tolerance for upside in the unemployment rate going forward. And that's where we say that the Fed put is in the market, because, the Fed's forecasting unemployment in the US at 4% by the end of the year. So, if we were to see the household survey showing continued weakness and the unemployment rate picking up 4.1, 4.2 in the months ahead, then obviously the Fed will have to act. And it does sort of throw weight that, they'll have to act potentially by September, which the market's putting a lot of weighting on at the moment. So, at the moment, the firm belief is that the Fed may need to cut rates, maybe not necessarily past the neutral rate anytime soon, but they will have some scope to massage the Fed funds rate a little bit lower. I think it's when the market gets a belief it goes through the neutral rate that we get a bit of a risk-off picture. But at the moment, the market is saying that that the Fed put is there, and why sell equity risk when the Fed have effectively got your back?
The consensus on the non-farm payrolls for the month of June, a solid 190K jobs added, and unemployment rate likely remaining at that 4%. But talking about really the economic picture, when you look at how we've been in this very low volatility environment for quite a while, a little bit of volatility perhaps in the bond side of things, but will that shock potentially come from the growth side of things if we see more talk and risk of a potential recession in the U.S.?
Well, I think if you look at the distribution on the inflation picture, it's difficult to say that we're going to get a significant upside in the inflation picture anytime soon, not unless the sort of big developments happen later on in the picture. Should we see a Republican red sweep? But I don't think that's going to happen anytime soon, obviously. I think really close to home, it's the growth side of the dynamic that everyone's focused on now, and the growth picture in the US is slowing down and deteriorating, not at an alarming rate, but if you look at the Citigroup Economic Surprise Index, it's the lowest levels really since September 2023. So data is generally missing the mark on a consistent basis. But it's actually the data change indices which is really becoming quite fragile now. And I think that's sort of lending weight that the US dollar may have some downside in the short term based on that dynamic. And of course, people are wondering what's the chance of the recession. We haven't seen that big bull steepening of the yield curves, which give us that high indication at the moment. But certainly, growth is the dynamic, I think, which is going to get more attention should this trend continue.
And I guess on the other side of the market action could be perhaps dollar weakness finally after 6 weeks of gains when it comes to the greenback, and what that is. What's the implication for Asian currencies on the other side of the trade, I guess?
Well, actually, I like dollar CNH lower at the moment. I think rate differentials has worked quite nicely in favour of upside on that trade, and the PBOC have only been happy to massage the midpoint on the yuan fixing every day higher and higher, and offset that by higher funding rates to make sure that speculators don't get out of control. But I think that what we're now seeing in terms of if you look at its generic US-China 10-year spread, that's now coming back in favour of shorting that pair in the short term, and I think there's probably a little bit of a move back lower in that trade there. Dollar yen on the sort of G10 side of things. Look, it's difficult to bet for that one to go lower. at the moment, but I feel like, yeah, it does look exhausted. And if you were to be short, obviously you're on the right side of intervention as well. But, that's been a very, very tough trade there as well. I think if we stay here, I think the trade at the moment is to stay long Aussie dollars against the US dollar. We're seeing yield differentials working well. If you look at one year forward rates, relative rates, there's a 20 basis point premium in Australia. Policy divergence is obviously there as well. And I think in this environment, while people are questioning US growth, it's at that point, it's in that sort of intersection where people are saying, look, the Fed puts their, growth may be cooling, that's fine. Rate cuts are still good for risk. We're not at that stage where people are generally concerned about US growth and global growth, that they de-risk their portfolios. When we get to that point, then the Aussie dollar's got big downside. But at the moment, we're in that kind of nirvana point for the Aussie, where we're in a sort of liquidity, rate cuts are good for risk asset sort of situation.
Yeah, especially when you're thinking that the RBA will hike rates and that probability rising. What does that mean for the equity space? I mean, we already saw the reaction of the Aussie gaining ground against the US dollar overnight.
Well, I think in the Australian equity space, I think there's still a lot of pushback on the idea that we're going to see an RBA hike anytime soon. I think the markets are sort of, do we get one? Obviously the Q2 CPI number on the 31st of July is going to have a big impact on that situation. It's going to make or break the August call. But I think a lot of people are saying locally here that there is a big difference between a token 25 basis point hike, which would be the RBA being a very reluctant hiker, to one where we start thinking that they're going to go on a hiking cycle. If we thought that there was going to be more hikes than one, then I think the economy would really break down quite sharply. I think consumers' behaviour would really come under pressure, and the equity market would be under pressure. But I think I think that's a very low probability.
Chris, we do have a redhead on the Bloomberg terminal. Japan's Topix index now trading above the record high closing level. I mean, this was pretty much expected. We were around those record highs for quite a while when it comes to the Topix. The Nikkei is also above that 40,000 level. Chris, when it comes to really that depreciation of the Japanese yen that we've been talking about, how much of a threat is that long term for the appeal of Japanese equity markets?
Well, I haven't been watching the flows into Japanese equity markets, to be honest. I mean, obviously, been watching the price action and the way that they've been trading. But in terms of international investors looking to get into Japan, I know last year there was lots of talk about Buffett and getting involved because of what's been happening with better economics. But I like what I'm seeing in Japan now. I mean, it's not just the fact that it is a yen move. I mean, we saw the Nikkei trading in a very tight range for a couple of months. It's broken out to the top side there quite convincingly, as we saw with the Topix. And I think even if you price that market in US dollars to take away the yen effect, it's still looking quite compelling. It looks like it wants to break out in dollars. So it is actually a genuine equity move. It's not just a currency move that's moving it up there. But, I feel like the market is underpricing Bank of Japan risk going forward. We've got 20 odd basis points being priced into the Japanese rates curve by the end of the year. I think it should be closer towards 50. Import prices are going up nearly 7%. Wages are going up. Inflation's going in higher, and obviously PPI is doing the same thing as well. I think the market's underpricing the risk that the Bank of Japan raised by more than what we're doing, which obviously sees a bare steepening of the yield curve. But at the same time, the equity market likes it. Banks look okay. So I still think there's some further upside in Japanese equities here.
Chris Weston, Head of Research at Pepperstone Group. Great to have you with us as we continue to watch the Japanese equity markets as the Topix is now trading above that record high closing level. Of course, we were expecting to see these new highs as Japanese equities have been rallying all week. The Nikkei also passed that 40,000 level. But when it comes to the Topix, we're seeing every sector in the green in early trading in the Asian session. Utilities, real estate, consumer discretionary stocks are leading those gains. We have more ahead on Asia Trade. This is Bloomberg. We continue to watch the political developments in the U.S. as we head towards a presidential election. We're getting a readout of the Biden-Harris campaign with Democratic governors meeting having just taken place, that President Biden is determined to beat Trump at the ballot box, according to the campaign. Of course, Democratic governors have also come out of that meeting with Biden, with one official saying that they are ready to stand with the president as he has lost a little bit of the support that we have seen across Democratic officials and perhaps even donors and voters after his performance in the debate against former President Trump last week, and this just 4 months before the election. So anxiety has been rising around the U.S. presidential campaign. Take a look at how Santos is trading in Australia. We're seeing shares now at the highest level since 2014, gains of 5% at the moment. Bloomberg's been told that Gulf energy giants Aramco and Adnoc are separately studying potential bids for the Australian gas producer. For more, let's bring in senior energy reporter Steven Sapchinsky. Steven, how much does this deal make sense?
It makes sense if you are a Gulf energy producer that's betting big on liquefied natural gas. Santos in Australia has been in talks over the last few years for a potential takeover, latest with Woodside late last year. Those talks didn't work out, but Santos has a very big portfolio of liquefied natural gas projects. They've got 2 projects in Australia. They also have a project that they have a stake in Papua New Guinea. So for Adnoc from the UAE or for Aramco from Saudi Arabia, this is a great opportunity for them to naturally just in a moment grow into quite a large supplier in the Asia region overnight, basically, if they're able to make this deal come through. The world's biggest growth markets for LNG are in Asia. I'm talking China, Southeast Asia, South Asia, including India, are big places that are going to require a lot more gas as they transition to cleaner fuels, as they move away from coal, and as they shift and they have to feed their growing economies and meet those energy needs. So Santos is well placed for that, and for a long time, Aramco and Adnoc have been trying to boost their exposure into the LNG game. Adnoc already has one LNG plant; they're building a second one. Aramco has very little exposure into LNG. They've been signing tentative deals from U.S. LNG exporters. They've also bought a stake in a company that has LNG assets, but altogether, they're kind of playing catch up to their neighbor Qatar, which is one of the world's biggest LNG exporters, and they're making a lot of money as the world shifts more to gas.
Given what you said about Santos, and I guess it's not surprising that they've already received several takeover approaches in recent years, how important would such an offer be for Santos, and would it make sense to sort of entertain these potential deals?
You know, we don't have the details of the deals, so it's hard to say exactly whether they would entertain them. And right now, it does appear that Aramco and Adnoc are in sort of the studying phase and looking at it. You know, Aramco and Adnoc are looking at assets all over the world. But for Santos to look at this, of course, they need to see whether the price fits, whether they're able to get the value that they want out of this. Considering that there is huge gas demand growth in the future, there are arguments that they are undervalued. It's also a matter of whether or not Aramco and Adnoc can offer that premium that shareholders want, that the board wants, and that management wants. So all of those together are going to be closely monitored. Of course, there's also a big question as to whether, you know, does Santos's outlook for future gas demand growth in Asia match Adnoc and Aramco? From just discussions that we've had with traders and people in the market, I think that they are aligned. But of course, we'll see what happens if an offer is made and how they do respond.
Our senior energy reporter Steven Sapchinsky there with that potential bid for Santos, as the company is now trading at the highest level since 2014. We're also watching Russian President Vladimir Putin meeting with China's Xi Jinping for the second time in 2 months. Putin telling the Shanghai Cooperation Organization summit in Kazakhstan that ties between the two nations are at their best in history. Meanwhile, Xi vowed to deepen coordination with Moscow.
In the face of the turbulent international situation and external environment, the two sides should continue to uphold the original intention of generational friendship, adhere to the perseverance of benefiting the people, continue to cultivate unique value of Sino-Russian relations, explore the endogenous motivation for cooperation between the two countries, and make efforts to safeguard the legitimate rights and interests of the two countries and safeguard the basic principles of international relations.
Russian-Chinese relations of comprehensive partnership and strategic interaction are experiencing the best period in their history. They are built on the principles of equality, mutual benefit, and respect for each other's sovereignty. Our cooperation is not directed against anyone. We do not create any blocs or alliances. We simply act in the interests of our peoples.
Let's bring in our Greater China Senior Executive Editor John Liu. And John, you just heard President Putin talking about how the bloc is not against anyone, but at the same time, there seems to be sort of a growing idea that these are non-Western nations that are gaining more in standing when it comes to that cooperation that they're realizing with this summit. What are both sides taking at this point?
I think this is what Vladimir Putin and Xi Jinping would say is they are trying to create an alternative to a world run by the United States and led by the West in general. Both those countries have really tried to find more scope for their own actions beyond the control or the influence of Washington and Brussels. And they would say that working together has helped them do that. I think some of the takeaways from this meeting, though, are that this relationship remains very strong between these two men. And we've seen lots of pressure put on by Washington and Brussels and other countries to try and, if not to limit Chinese support, maybe even to stop Chinese economic diplomatic support for Russia. And this meeting would suggest that that is not taken hold, that has not had an effect on this relationship. And China will continue to support Russia.
How important is Russia for Beijing?
Russia and China share a very, very long border. There is a strategic value for both countries. Both see the United States as sort of an antagonist on the world stage. Having that relationship, Xi having Putin and Putin having Xi, helps both the Russians and the Chinese deal with American power, and that is why they are coming together, because they find themselves in a mutually situations that they do not like. They do not like to be limited and restrained by American power.
Our Greater China Senior Executive Editor John Liu there with the latest on those geopolitical tensions and dynamics working out globally, which we can also see in the EV space. Chinese EVs holding on to their share of the slumping European market ahead of new tariffs designed to protect local car makers from lower cost imports. For more, let's bring in Asia transport reporter Linda Liu. Linda, so what's the situation for these Chinese EV makers in that market right now?
These new provisional tariffs that's due to take effect today in the EU would mean that it's going to add on to the cost of these Chinese EV makers bringing their cars over to Europe. Whether they can raise these prices in the European market remains to be seen, because the demand for EVs is already slowing. So it's adding to a growing list of challenges for these Chinese EV makers. Not to mention European and American manufacturers are also impacted. You have BMW and Tesla, which are big importers of electric vehicles they make in China, and they bring them over to Europe. So last we heard Tesla is trying to negotiate down the tariff for their EVs made in China over to Europe, and there's going to be more negotiation going on.
How well entrenched are these Chinese car makers in the European market right now?
Their market share is still relatively small. It's standing probably less than 10% right now of the bloc's EV sales. But that could change with BYD, MG. They're making offenses into the European market, launching new models. And they're hoping that with their more affordable pricing as well as high-tech features, they can win over customers in Europe. And of course, that kind of trend is alarming European manufacturers, which is what we're seeing now with the tariffs, with the EU hoping to adding these tariffs to slow down this expansion of Chinese EV makers.
We know that some Chinese EV makers like Leapmotor, for example, they are now forming partnerships with European car makers such as Stellantis and trying to produce from inside of Europe. Are we going to see a changing trend on how these Chinese EV makers operate?
Yes, Chinese EV makers have said they're willing to make more investments into Europe to try to localize production and hopefully evade the tariffs that we're seeing right now. Leapmotor is a good example because they partnered up with Stellantis, which has quite a few manufacturing plants in Europe where Leapmotor's models can be manufactured. You've also got SAIC, a state-owned Chinese manufacturer that owns the British origin MG brand. They said that they are definitely not going to give up on the European market, and they are actively looking to set up factory in Europe.
Our Asia transport reporter Linda Liu there, and we could potentially see even more pressure for Chinese corporates, especially in Europe, as Bloomberg has learned that the EU is working on a proposal for import duties on cheap goods bought from online platforms outside of the bloc, and sources saying that they would primarily target Chinese retailers. We're talking about the likes of Shein, Temu, and AliExpress. The EU currently has a $161 duty-free threshold for online purchases that's meant for small gifts or personal packages. We have more to come on the Asia trade. This is Bloomberg. Take a look at how European futures are coming online after French stocks outperformed the broader European benchmark on Wednesday. Of course, this is as we continue to see the political parties in that country maneuvering to block the far right. Of course, we are headed to Sunday's vote on the final round in French elections. This as we continue to watch, of course, the British stock markets. The FTSE 100, FTSE 250 ticked higher ahead of Thursday's general election, widely expected to bring the opposition Labour Party to power. This is Bloomberg. You're watching the Asia Trade. Dozens of Democratic lawmakers are considering signing a letter demanding that President Biden withdraw his re-election bid. A senior party official says Democrats running in traditionally safe districts are circulating the letter. Meanwhile, the White House has denied a New York Times report saying Biden had privately conceded the possibility of pulling out of the race. This all comes as Donald Trump's lead over Biden widens to 6 points in two major national polls. And Vice President Kamala Harris is emerging as a top alternative should President Biden step aside. David Ingles actually joining us now with what we're seeing in the markets in terms of these bets.
Yeah, you know, a couple of things I'd note, right? So on predicted implied probabilities, we are effectively seeing a massive spike over the last couple of days. In fact, we're seeing this. We've gone this week from about just under 15% to about 43% in terms of the implied probability for Kamala Harris. Now, it's also worth noting while you're seeing this pick up, and, you know, when you look at this specifically, this measure in isolation, you do see, of course, a massive pop. Now, what certainly matters is, you know, where markets think, or where the betting markets think the winner is going to be. In fact, that's the next chart. And as you look at that as well, it's also worth emphasizing at this point in time that we are going into holidays. So market reaction is muted. In fact, VIX futures, bottom of your screens, are effectively showing that there is no expectation of volatility picking up. That's number one. Number two is when you put everything together and you put Donald Trump, Joe Biden in here as well, you do see a pickup further in Donald Trump. nearing 60% of that, as expected, this collapse in bets around President Biden and a pickup, and we're now close to eclipsing, as far as Harris is concerned, eclipsing the probability that's being attached to Biden winning, not getting the nomination, winning the 2024 elections. Now, it's unclear if, and it's a big if, of course, and we've heard pushback recently, just last couple of minutes or so from the Democrats, if Biden drops out of the race. It's worth noting these are not ratings; these are probabilities. So it's unclear whether or not that gets simply added to Kamala Harris. It certainly would, but would it be in absolute terms? It's hard to say at this point in time. Shery.
Right, David, you can actually get more on that surprise resurgence for Kamala Harris in today's big take on the terminal and on Bloomberg.com. Now, Ukrainian President Volodymyr Zelenskiy saying that Republican presidential candidate Donald Trump should not wait until November after the election to disclose his plans to end the war with Russia. Zelensky spoke exclusively with Bloomberg about Trump's debate comments.
So let us imagine that the winner might be Trump in November, and he knows how to end the war. He has a plan. Me, as the president of a country at war, not a theoretical person, but a real-life person, I would like to be prepared. We are 40 million. We're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish war fast? Tomorrow, do we want the war to be over tomorrow? We didn't the war even to start. It was Putin who started it. But I hope you agree that it would be fair. If Trump knows how to end this war, he should tell us today, because if there are risks to Ukraine's independence, if there are risks that we will lose the statehood, we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US or we'll be all alone.
Ukrainian President Volodymyr Zelensky speaking exclusively with Bloomberg, and the Ukrainian leader also telling us that China could play an important role in ending the war with Russia. Take a listen.
I would like China to play a serious role. It's a big country, and really it's the second largest economy, and Russia really depends on it, because they don't have another place to export many of their goods because of the sanctions.
Those comments coming as the presidents of China and Russia met for the second time in less than 2 months. Xi Jinping and Vladimir Putin holding talks at the Shanghai Cooperation Organization Summit in Kazakhstan. Let's get analysis with Alexander Korolev, senior lecturer in politics and international relations at the University of New South Wales. Alexander, great to have you with us. So we are not really expecting Ukraine to be a topic at this summit. It could be talked about in the sidelines, but what are your expectations of sort of the narrative that could come out from this summit on Ukraine?
Mm-hmm. Well, I think the major narrative is that there is a rising club of the non-West, so to speak, and this Shanghai Cooperation Organization Summit indicates the changing nature of the organization. It used to be a very narrowly focused regional gathering, if you like, of just a few countries. Now, after the inclusion of India, Pakistan, Iran, and Belarus now, it's really becoming a global club of so-called non-Western countries, even though Belarus geographically is a part of Europe, but identity-wise it's questionable. So it is a mechanism through which now China and Russia push forward their shared views of the global international order. And I don't think speaking of Ukraine, it's a great news for Ukraine, because these demonstrate that more countries are being consolidated around a very different narrative. I wouldn't say it's Russia's narrative, but it's, at the very least, it's not Ukraine's narrative, and it's not a narrative that prevails in the West, in the so-called English-speaking space.
You mentioned India there, but we know that Prime Minister Modi couldn't attend. How awkward of a position is India now, given, of course, also the relationship between Russia and China playing out so visibly?
Well, India is in a tricky situation. India tries very hard to hedge its economic and security bets. India-China relations are very tense due to the rise of China, the growing assertiveness of China, and the border dispute between China and India. This creates a very strong incentive for India to get closer to the United States. India is not really an ally of the U.S., but it's an alignment, informal alignment. But at the same time, India understands that aligning with the United States would mean confrontation with China, and India is not interested in it. That's why India wants to continue cooperation with Russia, because Russia, for India, is not only a source of oil and weapons, but also Russia is a close partner of China, which means that an extra channel of communication with China. So India is trying to really navigate this complexity of great power rivalry, but in the context of intensifying China-India confrontation, if you like, I think Modi feels inappropriate probably to attend the Shanghai Cooperation Organization summit, which is dominated by China and Russia. But for India, it is a challenge, because you need to sort of play this multi-level game of not antagonizing China too much, maintaining some sort of strategic cooperation with Russia, but at the same time being incentivized to get closer alignment with the United States. This creates these centrifugal pressures on India, if you like. So it's a very difficult combination of pressures and forces that are not easy to navigate.
In a way, though, very helpful for Russia because of all these centrifugal pressures on countries like India. Russia can look not as isolated over Western sanctions.
Yes, exactly right. And I think this Shanghai Cooperation Organization summit indicates exactly that. That, yes, the relationship with the West is severely damaged because of Russia's invasion of Ukraine and the ongoing war. But there are many non-Western partners that are willing to cooperate with Moscow, and not only to continue business as usual, so to speak, but to actually invest in the enhancement of cooperation with Moscow. And a lot of attention is paid to Putin's visit to North Korea and the depiction of these two pariah regimes sort of talking about how to undermine the West. But an interesting detail is that right after North Korea, Putin went to Vietnam, and Vietnam has a reasonably good relationship with the United States and other Western countries. Plus, this Shanghai Cooperation Organization summit indicate that, yes, this narrative that, Russia is in the same category as North Korea and that nobody wants to really do business with Russia, I think doesn't fully conform to reality. And the recent developments demonstrate exactly that.
What does that mean then for this war in Ukraine, now really grinding into its third year already? The whole idea of these Western sanctions against Russia was to isolate Putin in order to be able to really push it away from Ukraine. Given the political risks also arising from a potential Trump White House come November, are the odds stacked against Ukraine at this point?
Unfortunately, I think yes, because the way there is a big miscalculation, I think, on the part of the West regarding Russia, because the original plan was to put enough pressure on Russia through economic sanctions to undermine the grip on power, Putin's grip on power through sanctions, through isolation, but that didn't work that way. Actually. Just a few days ago, I guess World Bank included Russia into so-called high-income countries. GDP, yes, Russia is going through difficult times economically, but it's nowhere close to what the let's say the American leadership expected. And for Ukraine, yes, it is unfortunate. I think the best scenario for Ukraine is together with the United States, together with China probably, and including Russia, to come up with some sort of neutrality status, which might put an end to this devastating war. It might not be an ideal solution, but looking at how things develop, I don't think there is an ideal solution. So you need to really live with the least worst case scenario, if we can put it that way.
The lesser of evils there. Alexander Korolev, good to have you with us. Senior lecturer in politics and international relations at the University of New South Wales. We'll have more ahead. This is Bloomberg. We're looking at record highs for the Topix, and the Nikkei also gaining ground, the longest winning streak since January. We are, of course, watching the Japanese yen as well, near 1986 lows. But at the moment right now, the big story is, of course, on that incredible rally that we've seen in Japanese equities. Let's bring in our Asia equities reporter, Winnie Su. Winnie, so the trading session today looking pretty optimistic given what we saw on Wall Street as well with that record high.
Yeah, exactly. Now we saw the Topix actually hitting the intraday record high, and we're watching if it actually can close at that level. And you see pretty much all the subsectors are rising, exporters still gaining on the weak yen, and financials still rising on the bet that the Bank of Japan is going to raise rates. So that's really meaningful because now we're seeing the rally actually broadening, and it's giving investors more confidence that this rally is more likely to last. So the structural story is still there because people are seeing Japan potentially exiting deflation and heading into inflation, and there's also the corporate governance playing out. So those are all supportive factors for the Japanese stocks.
I guess the question is then, how much more room does it have to continue gaining ground going into the second half, right?
Right. So most investors we've spoken to, including BlackRock, Morgan Stanley, they're still quite bullish about where the Japanese stocks are headed towards the year end, because the macro factors or the macro headwinds are likely to diminish towards the end of the year, but the structural tailwind is still there. And although the pace is likely to slow because the extreme weakness of the yen is still going to weigh on Japanese stocks when it comes to how potentially weak the domestic demand might be, and also the potential intervention by authorities coming into the currency market. And when it comes to dollar return, if we still have this weak yen, international investors might not be as excited to come back in yet, just because that's going to hurt their overall returns. So ideally, if we see that yen to strengthen a little bit, that might give more confidence for foreign flows to come in as well.
Our Asia equities reporter Winnie Su here with these latest moves in the Japanese equity markets, where the Topix is hitting another record high. Now, Hitachi is a Japanese conglomerate right now, bucking the trend and losing a little bit of ground. But this, of course, after an incredible rally already this year, gains of more than 80% year to date. The company saying that it's ready to spend hundreds of millions of dollars on acquisitions. Chief Financial Officer Tomomi Kato telling us exclusively that the focus of the deals will be on artificial intelligence and green energy.
We have three major sectors at Hitachi, including our business sector, in which we develop software. We are developing software for our customers, and of course we do the programming and coding. But we've learned through various demonstrations last year and this year that on average we can improve the efficiency by 30% or so, and we're now trying to incorporate this into our projects. This will help reduce the time and people needed for project development. If we had more human resources, we would be able to meet customers' needs better data. But if the productivity of coding is increased by the use of AI, we can take more orders and help customers looking to digitalize operations.
Which is why you're training 50,000 employees for generative AI as one of your business strategies. When do you expect all of this to start paying off in terms of, as CFO, when will it start affecting the bottom line?
I believe that we will see the effects of the return on investment starting this fiscal year. However, since it hasn't been long since the program began, the effect will be minor, and the bigger impact will come from the new medium-term management plan that will start next fiscal year.
How are you expecting those partnerships that you have with the global AI players like Microsoft and Google to factor into those calculations?
We are in the digital business, so we have customers who want to use AI but don't know how to use it, or what's the most efficient way to use it, or they want to use it but they don't want to release their confidential data to the public cloud, for example. How do we guarantee security? And how should we use the public cloud and on-premises servers, which we call a hybrid cloud? In this case, we need technology for data management. To achieve this, we of course have the technology, but for example, we do not make our own large language models, but use LLMs made by other companies and train them to become suitable for our customers and for us. In that sense, the alliances we have with Microsoft and of course NVIDIA, whose servers are crucial, are not only beneficial to us, but are also very effective in providing various solutions to our customers. I think this will help distinguish us from the competition.
The fact that we're seeing such growth in artificial intelligence and the infrastructure that might support the future, Hitachi having businesses across all parts of the economy, including, of course, a power industry. Are you factoring in that as CFO when you're looking at your numbers?
The effect of generative AI is extremely high in enhancing our productivity and the solutions we provide to our customers. As you mentioned, for example, the use of generative AI naturally requires data centers, and the demand for these data centers is increasing. Data centers require electricity, which in turn requires transformers and other power equipment. We have a business model called Power Grid in the green energy and mobility sector, where we also manufacture transformers, and orders for these transformers are also increasing. In this sense, we believe there will be a ripple effect from AI to data centers to the power grid.
Hitachi Chief Financial Officer Tomomi Kato speaking exclusively to Bloomberg. We have more on the Asia trade. This is Bloomberg. Recent regulatory troubles for PricewaterhouseCoopers in China have caused an exodus of clients, casting doubt over the firm's prospects in the country. Some of its accountants are also said to be seeking out jobs at rivals. Let's bring in Bloomberg's Lulu Chen, who leads our Asia investing coverage. Lulu, so how serious is this situation for PwC?
Well, since March, more than 30 publicly listed companies based in mainland China have dropped PwC as their auditor. The troubles really started picking up after China's investigation into Evergrande, saying that they vastly overstated their revenue and profits, and PwC came under scrutiny for its role in the misstatements. China is weighing a record fine on the accounting firm, and they may suspend some of its local operations, sources have told Bloomberg News.
What does this mean then for the future of the company in China?
Well, you know, PwC was already struggling with this issue before. They're struggling with this issue even before the regulatory fines come, and I think most of all, it's a factor of a weighing on their morale. While we don't know how many staff have left or are considering it, partners at other major international firms and accounting firms have received dozens of job inquiries at their peers. Also, I think if you look at the competitors, it's both the other big four auditors, the foreign auditors, and also the local firms that are benefiting, taking away business from PwC at this point.
Lulu Chen, who leads our Asia investing coverage with PwC's concerns across China. Some other corporate stories that we're following at the moment. JPMorgan's chief global market strategist, Marko Kolanovic, is leaving after 19 years at the bank. An internal memo obtained by Bloomberg says he's leaving to explore other opportunities. Kolanovic had a disastrous 2-year stretch of calls on the U.S. stock market, staying bullish as the S&P 500 tumbled in 2022, then turning bearish as the market bottomed and rebounded. Japan's annual pay negotiations have ended with the highest raises in more than 3 decades. It confirms the upward trend in wages sought by the country's central bank. The final tally from Japan's biggest union group shows that employers have agreed to raise pay by an average of 5.1%. That's slightly lower than the initial figure from March, after the group included more deals from smaller businesses. Take a look at how futures are trading at the moment as we set up for the market opens in China. We have seen Wall Street with another record high, and that's really sent Asian stocks soaring, as well as we are now seeing the Topix trading at around that intraday record high. We'll see if we close at those levels. The China show is next. This is Bloomberg.